Good morning, everyone. I'm Aditya, Director of Growth at Leegality, joined by my colleague Ancha, who will be making the opening address and introducing our panelists. Ancha, over to you.
Right. Thank you for that, Aditya. Hello, everyone. Good afternoon, and welcome to this webinar on the new RBI Master Direction relating to the issuance of credit and debit cards. Thank you for taking time out of a busy weekday. And out of respect for everyone's time here, we promise to keep this to an hour in which we will cover everything you need to know about these new changes introduced by the RBI with respect to how entities must issue cards and interact with their customers. But before we begin, I would like to introduce our esteemed panelists today. We are extremely pleased to welcome onto the panel Mr. Anu Tiwari, partner and co-head of the fintech practice at Cyril Amarchand Mangaldas. Unfortunately, he's caught up on an important matter, but he will be joining us shortly within a few minutes. Anu represents Indian and multinational fintech, banking, information and emerging technology companies on transactional enforcement and regulatory matters. He has extensive experience advising financial services clients on matters before the RBI, SEBI, Ministry of Finance, ED, appellate tribunals, and the Supreme Court. Along with Anu, we also have with us today Ms. Shahryar Khanum, consultant with the fintech practice at Cyril Amarchand Mangaldas. She has around 11 years of experience in the banking sector and now advises on the regulatory aspects of the fintech sector. Thank you, Shahryar, for joining us today. Your extremely valuable insights into this new regulation will prove most useful to all of us attending today. And so before we get into the meat of the talk, let's first see what we will be covering and more importantly, what we will not. In the course of this discussion, we will be covering three broad topics relating to the Master Direction. Who the Master Direction applies to, what are the material changes that the Master Direction brings in, and the operational implications of these changes on card issuers. These rules kick in from July 1st, which is why the last point assumes major significance here. Our focus on what the changes are that are being introduced means that we will not be giving a complete summary of what the Master Direction says. This is not a primer on the entire law laid down by the direction. And lastly, this is not a legal opinion. These are our findings based on our research, analysis, and market experience. If you have any divergence of opinion, we would love to discuss that with you, either in the Q&A at the end or even after the webinar is over. And the final call on any of these issues that we discussed today must be taken by you and your compliance team. So the webinar, we've divided the webinar for convenience into three different parts. The first 5-minute section is on the applicability of the Master Direction. Then comes the main crux of our discussion, which is all the changes that have been introduced by the Master Direction, and importantly, how to comply with them. That should last for approximately 30-35 minutes. And then we will open the floor to any questions that you may have for our panelists today. So with that, let's begin the first session on applicability. The provisions in this Master Direction relating to credit cards apply to every scheduled bank and NBFC in the country. 3 entities, payment banks, state cooperative banks, and district central cooperative banks do not fall under the purview of this Master Direction. And the provisions in the direction relating to debit cards apply to every bank in the country. So this brings us to an important clarification. Is this Master Direction the be-all and end-all of all the RBI regulations relating to credit and debit cards? Well, yes and no, right? Yes, because it is a comprehensive set of rules and regulations with respect to what it covers. Eligibility conditions, issuance of cards, dealing with customers, penalties, co-branding, etc. However, there are other aspects relating to the running of a cards business which are not covered under this Master Direction. And on such aspects, the direction is clear that it should be read along with prudential, payment, technology, and cybersecurity related directions applicable to credit, debit, and co-branded cards as issued by the RBI from time to time. So that was the first small bit on applicability. And now this brings us to the main part of our discussion today. The changes being introduced, the new business opportunities that are being presented, and the compliance issues that need to be mandatorily addressed by July 1st. So first we will cover what the Master Direction says with respect to non-bank financial entities. We have with us Ms. Shahryar today to take you through this part of the presentation. She will talk to you about the significance of including these entities within this Master Direction. So with that, over to you, Shahryar.
Thanks, Aditya, for that great introduction. As Aditya mentioned, this is not a legal opinion. Although I'm a lawyer, I shouldn't be saying that, but this is more of an analysis of what has come as a consolidated set of guidelines on credit cards. As you would have, those who are interested in the sector would have already known that while there are some new introductions in this master direction that the Reserve Bank of India issued, but somewhere it is just a consolidation of what was there already. And to a certain extent, it's also sort of spelling out certain things clearly, which were mentioned there previously in the directions that have been issued by the bank from time to time. But now they have been written more clearly. There is also lack of clarity on certain things, which we'll get into, but more or less, it sort of broadly sets out certain things. So what does this master direction essentially deal with? So insofar as banks are concerned, we don't see any significant deviation or change from what has already been there in existence insofar as the credit card business of banks is concerned. But you do see changes with respect to regional rural banks, scheduled commercial banks, urban cooperative banks. There are certain changes that have been made in the master directions. So for instance, in case of regional rural banks, now the change that has been provided is that only regional rural banks that have a net worth under 100 crores, those are the ones that can issue credit cards. Then in terms of urban cooperative banks, there's a minimum net worth requirement. There's a comprehensive banking system that they must have in place. And there's also reference to the other direction that RBI has previously issued in terms of the asset value. Who are the individuals to whom these credit cards can be issued? My favorite part in these directions is actually the NBFC part, because there are varied opinions in the market, but the way we read it is there is more opportunity for NBFCs than worry. And that's the way we see it, for a simple reason that the directions very clearly set out that non-banking financial companies can approach the Reserve Bank. I mean, of course, the language is written in a negative way, but the intent is to say that you require prior nod from the Reserve Bank of India. Now, the good part that we read here is there is actually an eligibility criteria which has been spelled out within these directions. So that means if you're complying with the net worth requirement, if you're procuring the certificate of registration, then you can apply for specific permission. This also ties into the other big aspect of these credit card guidances, which is basically the co-branding aspect. And we'll come to that at the later part of the presentation. And we'll, of course, take questions as well. But the way we see it, like I said, there's more opportunity than loss of opportunity for NBFCs. As you all are aware, previously, non-banking financial companies were only issuing credit cards in tie-up with banks. So in that sense, NBFCs that do fulfill the criteria that the regulations set out, they will to that extent be able to apply to the Reserve Bank of India. Of course, nobody can comment on whether the regulator will issue the license or whether they'll be forthcoming. That has to be assessed on a case-to-case basis. But for sake of clarity, we do think that this presents more opportunity for NBFCs than not.
Shahryar, just before we move on, just have a slight question on what you just said. So since 2004, I mean, the requirements were also contained in an RBI letter of 2004. And on the basis of that, I think there are 3 NBFCs, as far as I can count, which do issue credit cards directly. So does the inclusion of this explicitly in a master direction, as opposed to say an RBI letter earlier, does that have any implications for, or is it going to be as ad hoc, where only a few select NBFCs will be issued licenses? How is it likely to work? Obviously, an educated guess, we can't ever really know until it actually happens.
Yeah, as a lawyer, I always give a word of caution that you can never second guess the regulator. So in plain terms, I don't know how many NBFCs will be granted this. But like I said, because, see, again, going to the first part that I said, this is actually just a consolidation of what has been there already. But the way it has been drafted and taking into account the requirement of mid-rung, mid-income customers in India who are not normally eligible for credit cards with banks, taking that need into account and taking into account RBI sensitization of that market and the focus on customer convenience that has increased manifold in the last few years, it does look like there is more possibility of the NBFCs getting the license to issue credit cards than not.
Great, Shahriyar, and I'm sure we will receive some questions also towards the end on this point, especially when you cover the co-branded aspect.
Right. So thank you for that, Shahriyar. And so with that, I would now like to talk about some new business opportunities that this master direction presents, which banks, if they feel is feasible for them, can now exploit. So firstly, there are two new types of credit cards that have now been explicitly recognized by the RBI. While some banks already do offer these cards in the country, the RBI has now recognized them explicitly and laid out certain terms and conditions that shall govern their functioning. Let's first discuss business credit cards. The old master direction, the 2015 master direction, only had corporate credit cards as a category. and corporate credit cards have been retained in this one as well. But business credit cards is a new category that crops up in this master direction. And the difference between the two is this. Corporate credit cards are issued to employees of a corporation. They help businesses regulate how employees spend money on business or corporate expenses. Business credit cards, on the other hand, are issued to business entities, smaller businesses, or individuals such as business owners, sole proprietors, and professionals who earlier would not have been eligible to get a corporate credit card for themselves. And so this card can only be used for business expenses and not for personal use. The second one here are charge cards. It is a type of credit card where the user has to pay the billed amount in full on the due date after the billing cycle, and no rolling over of credit to the next billing cycle is permitted. So, as I said before, there are banks who already offer these cards, but the RBI mentioning them as a new category in this master direction clarifies any doubt that one may have had on whether it's legally valid. And in doing so, the RBI has also been able to lay down some rules regarding these new products. And for example, in India, I think only Amex offers the retail variety of charge cards. So by defining it in the by defining it in this master direction, the RBI has specified the scope of activities and benefits that such cards can provide. Aditya, if you could move to the next slide. Yeah. Another new interesting development has been the introduction of form factors for debit cards. Now, form factor is a physical or virtual instrument that can be used in place of a debit card to undertake any payment or banking transaction. These could be in the form of wearables such as watches, wristbands, rings, etc. And just like how the tap feature on credit and debit cards have helped further the contactless payment ecosystem, these instruments may also see a good demand in the market for similar reasons. So coming to this section, a common feature throughout this master direction has been RBI's insistence on obtaining the consent of the customer before undertaking any activity. And the first way in which the RBI insists on recording customer consent is by making it mandatory for card issuers to get the agreement which contains the contractual terms and conditions signed by the customer. So prior to this master direction, card issuers would only have to send out a document containing the important terms and conditions of their relationship with the card. And they just had to send this document to the cardholder, basically saying that, listen here, these are our XYZ terms. And the customer would just simply accept them either over the phone or click wrap, if at all. But now, The words signed agreement have been introduced in the new master direction, and this is significant. You may be wondering right now that the MITC, the more important terms and conditions, were always sent to the customer. While the introduction of the words signed agreement may seem like a trivial change, I will show to you how and why this is significant. Any document required under law to be signed, as is the case here, has to mandatorily follow a specific, well-defined method of execution. Let's zoom out a bit. Let's take a step back. As the law stands in India today, contracts can be entered into using a variety of methods that you see on the left side of your screen. Loan agreements, vendor agreements, any credit card agreements also before July 1st could be executed using any of these methods. However, when a law or regulation specifically mandates a signature as the mode of execution, only physical signatures and IT Act recognized electronic signatures can be used to sign such an agreement. I'll give you some examples. Demat account opening forms, copyright assignment deeds, and now this credit card agreement post July 1st can only be signed by your customer using either physical vetting signatures or IT Act compliant electronic signatures. And I'll tell you why this is the case. It is by virtue of Section 5 of the IT Act. What Section 5 says is that if a law mandates a signature, then to execute such a document digitally, you can only use electronic signatures recognized under the IT Act. So what you see on the screen right now is what we call the matrix of validity. For documents which must be signed under any law or regulation, other electronic modes of execution that you see on the right, such as virtual signatures, email, click wrap, will not be legally valid. Only IT Act recognized electronic signatures can now be used to sign this agreement. So what does this mean for credit card issuers operationally? If you're following a physical flow and collecting physical signatures on paper, well, then it is legally valid. But sending a paper-based agreement to your customer spread across the country and then asking them to send it back, it's an operational nightmare. It increases the turnaround time. It will reduce the number of credit cards you can issue in a given period. It makes for a frustrating customer experience. And lastly, paper agreements are always difficult to store and keep track of, and also produce and reproduce during an audit. That is why most banks today have already gone fully digital with their credit card onboarding flows. So for operational convenience, you may choose to get this credit card agreement signed digitally. And as we just discussed, click wrap based consent through your banking app or virtual signature impressions will not be legally valid to now execute this new agreement, which is mandatory under the new master direction. Only IT Act recognized electronic signatures such as Aadhaar e-sign, PAN-based e-sign, and DSC tokens can be used to sign this agreement. And with that, I will now hand over the mic to my colleague Aditya, who will take you through the next plank of activities for which customer consent is now required.
Thanks, Anja. Shahryar, it's a pleasure having you at the webinar. So Anja has covered the contractual aspect of consent reforms that the new RBI Master Directions have made. I'm going to cover another aspect that is often overlooked of this new consent reform, right? So in the old RBI rules governing cards, 5 key authorizations required what is known as explicit consent. And if you can see through this small screen in the corner where I am, I'm using air quotes when I say explicit consent, and you will see why in a bit, right? So levying new charges, activating unsolicited cards, offering unsolicited loans, upgrading cards and enhancing limits, revealing customer information. Essentially, after you get the card, apart from paying with the card, there's a ton of other things you still need to interact with the bank with respect to the credit card, right? And that's what you need this explicit consent for. right? And this explicit consent in the status quo is taken through a myriad of ways, right? And I'm sure everyone in this webinar has got a call from their bank many times asking if they want an enhanced credit limit, right? First time I received such a call, I was kind of pinching myself. Like, this was my first credit card when I first received the call, and I make very minimal spends through the credit card itself. The person from the bank on the other end of the line simply asked me, sir, you're eligible for enhanced limit. Do you want it? I said, yeah, of course. What do I need to do for it? And literally the next second, they said, nothing, it's done. You've got the enhanced limit. Just check your credit card is now availing of the enhanced limit. So in the status quo, that was explicit consent. For some other functions, like say activating a card, you may need to perform a series of steps through your online banking portal or a net banking app. That's also explicit consent. Basically, in the status quo, there's no unifying principle behind what is explicit consent. It seems like anything vaguely resembling consent would be explicit consent. And like now you know why I use the air quotes, right? So this changes though, right? And what exactly has changed under the new regulations? Two very important things, right? For starters, the range of activities for which explicit consent is now needed has been expanded to 12 different activities. And just looking at the 12 different activities, it makes a lot of sense. These are common sense additions for explicit consent, right? Points 6 to 12 there, right? But this is the smaller change with regard to explicit consent. The bigger change to consent is not the increase from 5 items to 12 items. It's that the words explicit consent have now been explicitly defined in the new RBI rules. So my air quotes earlier are now gone. So whenever I say explicit consent, now no more air quotes. So what is explicit consent under these rules, right? It's one of two things. And this is an either or, you don't need to do both, right? One is written physical consent, right? And this operationally will probably involve someone coming to the branch for anything and everything, and banks maintaining a large paper trail of the consents themselves, right? Practically, we all know this is unfeasible if for these micro consents, you're maintaining a paper trail, which is why the RBI has also given an option of digital consent, right? But, and this is critical, not just any digital consent, but digital consent backed by multi-factor authentication. Essentially, the rules are prescribing for digital consent, they're prescribing a two-layer digital consent process. One is a form of expressing consent. This can be in any form for these 12 micro consents, right? It's not specified, can be a yes or no box, can be a digital signature, can be a toggle. But whatever mode of expressing consent you use, you need to back it with a multi-factor authentication accompanying this digital mode, right? This can be 2-factor, 3-factor, 4-factor authentication, completely up to you. So actually, because of this digital consent norms, what you need to do here is not simply look at the new consent items added. So in that list above, I showed you items 6 to 12 of things that now ask for explicit consent. It's not enough to just look at the new items and see whether you're meeting the norms, right? You will need to relook at all 12 activities that you do in that list, old and new, and see whether you have either A, written consent in that flow, or B, digital consent backed by multi-factor authentication. You will essentially have to relook at every one of those 12 points through this prism and ensure it's compliant from July 1st onwards. Okay, and there's a kind of hidden requirement that's often easy to gloss over. It's that the mode of digital consent that you use, right? The new rules say that this alternative mode of digital consent that you use shall be communicated to the RBI Department of Communication. Now, whether this is a one-time communication where you're simply just notifying them that this is the mode I'm going to use, or whether it's a repeated one where you're giving them details of each and every consent that you're collecting, we'll be honest, the rules aren't clear on this, but they do specify that the alternate digital mode of consent must be communicated to the RBI Department of Communication. Okay, now veering away from theory, let's look at how this new consent system would work with some illustrations. So right off the bat, that older illustration I mentioned earlier, where I got my credit limit enhanced, right? where a bank rep calls me, hello, sir, you're eligible for increased limits. I said yes, and it was done, right? And I was very happy about it when it happened. And I'll admit it's great for my convenience, this status quo approach. But this approach is completely non-compliant with the new RBI consent regulations. You simply cannot do this anymore unless there is also either written consent or digital consent backed by multi-factor authentication. Now, I'm going to make a very big assumption here and say that no one really is interested in that physical consent or maintaining a paper trail of each and every consent. If you are, then it's pretty obvious what you need to do. I'm going to cover two potential flows for digital consent, right? Like, so how will this work now? One is, of course, the online banking portal or net banking app flow. What will happen in that same scenario? The bank rep would have called me, informed me about the enhancement of credit limits. I will say, yes, let me upgrade, but it doesn't end there. The bank rep will tell me to open the net banking portal or app. At that stage, they will probably also need to configure something from their end that to ensure that this appears in the app. I will need to log into the app with guidance from the rep if necessary, and go to that part which has this option of consent for this particular authorization, right? By the way, this login is the first factor of authentication because I need a unique password to log in that only I know. Second, when I'm on that interface and I press that button to say give the consent or press that toggle for enhancement of limit, I probably will need to give an OTP as the second factor of consent, either via my phone, email, or both. This is the additional factor of authentication. And it's only after this that I'm done, right? And if you're looking at the RBI communication requirements, the bank would probably need to maintain a trail that I'm giving this consent. Now, I'm sure some of you have identified issues with this, right? Some customers may not have access to the net banking app at that moment when you call them for enhancement of limit. The app itself may be facing downtime at that moment for factors outside the credit card vertical's control. As a result, you may face a drop-off for that particular authorization at that very moment in time. So how do you work around this? That brings me to the second type of digital consent that you can follow, right? Not the net banking flow, but a system known as direct digital consent. Direct digital consent is consent given outside the confines of a net banking app, right? Here, let's look at it through the illustration. Like earlier, the bank rep would call me, sir, you're eligible for credit limit increase. I say, yes, of course, I'm interested. I would then, instead of logging onto the net banking app, receive an SMS or an email with a link, right? And this is probably activated by, say, a click of a button on the rep's end, right? In that link, I click on the link. A consent language document will open up on my phone itself or on my computer if I've accessed it through email on my laptop, right? And this document will open with clear consent language for this particular authorization. It will then ask me for an OTP. And this ordinarily in a direct digital consent flow will be via phone and email, right? Or maybe an OTP via phone and or email and my bank PIN, or maybe like an Aadhaar digital signature to meet the multi-factor authentication requirement. Above this, of course, there will be a button there where I have to click to actually express the consent apart from the multi-factor authentication. So operationally, for these two things, what you will need is for the banking app flow, you will need to ensure OTP authentication for any toggle or button that activates one of the 12 items for which you need explicit consent. You need to ensure this in your net banking app. Two, if you are being abundantly cautious, you will need to record and store this consent to be able to communicate or show it to the RBI. As I mentioned earlier, it's unclear as to whether you have to show every single transaction or whether you simply need to convey the mode to the RBI Department of Communication once and they audit that mode at regular intervals. Again, that's unclear here. For the direct digital consent flow, you need a direct digital consent utility. This you either build or buy, right? It's something that will operate outside your core banking system to get consent, but it will need to generate an audit trail or consent record that feeds back into your core banking system. So you have that verifiable consent trail. So that in totality are the consent requirements under the new RBI Master Direction. The requirement of a signed agreement, which changes how electronic agreements happen for credit cards, and the requirement for digital consent backed by multi-factor authentication. We will be sending you this deck within 48 hours of this webinar. So in case you missed out on any point, you will have it written on this deck for your ready reference, right? And these consent requirements really are not written about in popular reporting around these new regulations, right? But the legal folks on this call will know that it's often these boring, seemingly small items around things like consent and agreements, which require the most operational and technical work to solve. With that, I want to move on to one of the more controversial, you can say slightly controversial, depending on where you stand, part of the new rule change. And it depends on which perspective you look at it. It's either a boon or a bane. The new stipulations around co-branded cards. Here, I want to hand it over to you, Shariar. Having worked in the field, especially with fintechs, what's your view on the new co-branded stipulations? Because from a layman's perspective, it seems very strict and harsh on what fintechs do now with regard to co-branded cards.
Thanks, Ancha, and thanks for that insightful 10-15 minutes on the consent bit. Just to add to what you already said, I think the idea somewhere, and that's sort of the larger takeaway from these directions, is to ensure customers are inconvenienced the least. Most often in day-to-day conversation, we talk about how often we get these marketing calls from banks or co-branding partners, which do somewhere also constitute as unsolicited calls. And the directions are very clear on the fact that that's something that issuing entities must avoid. There's in fact a specific reference to the telecom regulatory authorities' directions on unsolicited calls. Having said that, moving on to the co-branding, and like you said, I'm not sure if I'll choose the word controversial. It is a bit tricky, and we'll see how this eventually pans out. So before going into the change in the co-branding arrangement under the master directions, I think if you generally look at the data and analysis around co-branding, while it has been a growing model in the market, some of the issues that have been identified with co-branding is, first of all, when issuing banks and co-branding partners generally tie up. Not to comment on individual tie-ups, but generally as an industry, there is sometimes a tendency of a mismatch between the co-branding partnership in terms of their approach, in terms of their business models, in terms of compliance, etc. So that's one of the things. The second is from banks' perspectives, because normally the tie-up is between a bank, which is allowed to issue the credit card, and the co-branding partner. There's also a lot of, at least prior to these directions, a significant codependence on the co-branding partner, right? And lastly, if things were to go south for any of the two partners, there's a significant reputational risk that is involved. So keeping these three broad parameters into account, you can then sort of see why the co-branding arrangement has now been sort of streamlined. So what has really changed, right? Co-branding is still allowed. There's no restriction. You don't need to go to the Reserve Bank to do a co-branding arrangement, but the role of the co-branding partner has been significantly modified. So they just become the initial mode of contact between the customer and the issuing bank. They also become the initial port of redressal. But once that transaction, that relationship takes off between the end customer and the issuing bank, as the scheme sits today, the co-branding partner doesn't have any role, right? One of the important, and this ties into the three sort of downsides that I highlighted on the co-branding model, there is now also a significant focus on due diligence, right? So when banks are co-branding with a co-branded partner, it is important that they conduct the necessary due diligence on that partner, right? And also ensure that, so there's a whole bunch of things. For example, whatever is the revenue sharing arrangement, that has to be displayed. The name of the issuing bank and the co-brand entity. I mean, things that were already there, but I'm just saying in the larger scheme of things, I think what the regulator is somewhere trying to say is to minimize the role of the co-branding partner. So from maybe banks' perspective, that's actually the only change that has happened, is that we may see a dip in the co-branding arrangements because now the onus of a lot of responsibility has shifted on the banks, which was earlier there on the co-branding partner. So, for example, redressal mechanism, any kind of chargebacks, all those responsibilities sit with the bank. But the upside from the NBFC point of view is that the initial part of the presentation where we did talk about NBFCs now hopefully being able to do the credit card issuance themselves. They may or may not, I mean, I'm completely cognizant that there's a totally different economics of scale involved in co-branding arrangements. But if the NBFCs are able to issue the cards now on their own, then that's the fact that they may or may not want to do the co-branding is something we'll have to see, right? Depending on how that works out economically for them. But those are the key takeaways, two key takeaways on the co-branding arrangement that the master direction sort of consolidate. And like I said, there's a shift in onus on regarding a lot of things on the issuing bank as opposed to the co-branding partner.
So Sharia, we've received a question in chat on whether this would apply to prepaid cards as well. I think these are charged. Ansha, if I'm not wrong, these are the charge cards, or this is?
It depends on the nature of the
No.
instrument, right? If it falls
Right.
within the direction of debit or credit card, then
Correct.
it will apply.
This also requires, for prepaid cards in this master direction itself, RBI specified that it's also subject to the master direction on prepaid instruments issued separately. So
That's right.
Yeah, we'll have to look into that as well. But
Right.
Shreya, based on your discussion, I had one question for you. So given that such a change has happened where the role of the co-branding partner entity has been scaled down, without commenting on individual existing co-branding tie-ups, there are some which fall foul of the new regulations, which currently do not adhere. So what's the way forward for them? Do they just need to communicate to the RBI? Will they have to now completely let go and change the whole co-branding structure?
Because there is a timeline within which compliance has to be made. I think it's July. That's the time given. I was actually reading up about existing tie-ups that are there currently. And I think statements have been put out by entities that they do not, as of date, sit in compliance with what the master directions have given.
Oh.
So they will have to move towards compliance because the master directions, in my plain reading, don't make a carve out saying that if you already have an existing arrangement, you can continue for it to be the way it is. So they will have to ensure compliance as well.
Right.
That's interesting. So basically, the UX burden, which this whole co-branding arrangement was about, where the UX of the entire card experience would be with the fintech, where the underlying financial backing of the card would be with the banking entity. Now it's kind of like the banking entity also needs to have the UX burden. So in line with what you said about NBFCs, if NBFC licensing, RBI comes up with rules for that, do you think we'll see more arrangements like where fintechs and NBFCs enter into, say, a joint venture, not a co-branding, but where they incorporate a third company and incorporate that as an NBFC to issue credit cards, kind of say like the Bharat Pay Centrum tie-up for Unity Small Finance Bank. Do you think those arrangements are kind of incentivized now in the medium term, at least, or the long term?
Absolutely, because now for lack of better words, the reliance on traditional banks will sort of go down, right? Because of the flexibility that has been allowed in terms of the NBFCs. So there is possibility of a tie-up, and like you said, like a joint venture as opposed, it will be in the nature of a co-branding only, but between fintechs and NBFCs. But if you look at, I think, like I said, that for me, the takeaway is, and I'd like to hear if there are any different views in the audience on that, but when you largely read about the reviews on these guidelines, everybody says nothing has changed for banks. I think co-branding arrangement is one significant change for banks, because if the dynamics of this co-branding arrangement have completely changed, because the way we read co-branding arrangements previously it was more about the co-branding partner, and they were sort of tying up with the bank for the compliance part because they couldn't on their own issue them. But if now the burden has significantly shifted on banks, it's also to see whether banks will want to do these co-branding arrangements or not. Because like I said, there's been significant shift of onus on these banks. I think we have a question.
Yeah, I think it's along the similar lines of the initial responsibility still being with the card issuer, and what the difference is in the updated section. I think Ansha, before that, if you can move on to the previous slide, I think that was more relevant for this question. This slide.
In terms of in terms of initial responsibility, you're absolutely right. Nothing changes. The initial responsibility of doing the tie-up, doing the marketing, the initial port of redressal, that still lies. What has changed is two things. One, once that initial tie-up is done, once the customer is on board, the role of the co-branding partner ceases. Second, they do not have access to any customer data, which is a significant issue for a co-branding partner because they would earlier rely on customer data. So transaction documents, any details of the transactions, those are something that will no longer be available with the co-branding partner.
Right. And I think even interfaces, the interface where I access my statements, because there are a few fintech apps where I can access, if I have a co-branded card, and I think Ansha was telling me about it, one of his roommates co-branded card with a fintech and a bank, the access to the card portal was on the fintech app.
Which will now not be possible because there is a complete restriction on access of data. So even if the interface is being used, that can amount to access to data. And this comes in light of, I don't want to, sort of digress from the topic, but data privacy has been a big issue in India, right? We've seen so much of litigation discussion around data privacy. And I think this change is somewhere stemming from that. Tying into our earlier discussion on, securing the interest of the customer, which is why your whole bit about taking explicit consent, not making any unsolicited calls, not allowing access of data to entities other than actually the credit card issuing entity, which is the issuing bank here. So I think that's sort of the broad driving force of these directions, apart from, of course, consolidating the whole framework. So I think once we keep that in mind, then understanding a lot of stuff within the directions becomes relatively contextual then.
Great. Will be interesting to see how this plays out in the
few months. Absolutely.
Post July 1st.
I'm quite thrilled to see how this is going to pan out. Like, are we going to see, because we've seen so much of co-branding in the last, I think, 10 years, starting, I think one of the earlier examples that I remember is airlines started this co-branding. And then it so happened that the credit cards, there was a tendency among customers to identify them more with the co-branding partner than with the bank. So I think that's going to take a significant change. I think we also have a question.
Let me see. If there, so the question is, if there is no access to customer data by the co-branding partner, in the event of any regulator's requirement like AML, etc., can co-branding partners seek this data from the bank? And can this be added contractually in the agreement between partner and a bank? Can a carve-out be contractually done?
This is an interesting question, but I would think that it will have to be an exception than a norm, because the onus of the transaction completely rests with the bank. So the moment you say that for the sake of AML, I need data, then how the RBI allows access to that data may be in contravention to what the intent here is, because there's a blanket, there's no exception, unless you guys read it differently, there's no exception to what is the data that can or cannot be shared. It just says that data related to the transaction cannot be shared with a co-branded partner, and their role sort of terminates. But the moment I say that for AML compliance, I need access to that data, I'm sort of carving out an exception.
Yeah, and I think these are that with the new regulations, there are always these ambiguities that probably require a clarification, no matter how much we try to read into it. It will actually require explicit clarification on these specific regulated points.
We're what 2 or 3 weeks from the time the regulations have actually come into being, and these are very bare readings of what we see, right? I think in the next few months, things are going to be much more clearer once we actually analyze approach of entities. And I think in this, the initial reaction of the Reserve Bank of India to allowing credit card issuance by NBFCs, that will have a significant bearing, because let's say the trend so appears that NBFCs don't get the licenses quickly, then their reliance back on the co-branding arrangement will again see a significant jumps. But if NBFCs actually get the licenses easily to issue credit cards, then their reliance on co-branding may not be so much. So it's going to be a bit of an interplay between the two. And like you said, we will, it's an interesting space to watch, and we should hopefully get some more perspective with passage of time. Over to you.
Great. Thanks so much, Sharia, for that. And thanks for the lively questions from the audience. I think that really added a lot to the discussion. on something where I think questions will continue post July 1st as well. So with that, I'll hand it over to Ansha again, and I'll reshare my screen onto a very small aspect of the master direction, but in the interest of thoroughness, we thought we should cover it. Miscellaneous provisions. Ansha, go ahead.
Yeah, thanks, Aditya. So this will in this part, I just want to cover some last set of minor operational changes that card issuers will now need to carry out. First, closure of credit cards. Earlier, card issuers were supposed to, quote unquote, honor immediately any request for closure of a credit card. However, now that time period to honor that request has been set by the RBI to 7 working days. The card issuer also needs to provide an option to submit such a request for closure through multiple channels. And the cardholder must also be immediately notified about the closure through email, SMS, etc. Second, with respect to disputed transactions, card issuers cannot levy any charge on transactions which have been disputed by the cardholder as fraud until the dispute is resolved. Then comes a new addition, which has been termed as a one-page key fact statement. This shall have the important details such as rate of interest, quantum of charges, etc. And this needs to be provided along with the credit card application itself. Then next, card issuers must have and also make available on their website a board-approved policy for issuance and conduct of credit cards, which must also mandatorily contain certain details such as interest rate, ceiling, etc. And also these the credit card operations of an issuer must be reviewed on a half-yearly basis by the audit committee of the board. Then comes the minimum amount due legend, which appears in all billing statements. So this has also undergone some changes. The words highlighted in green there reflect the change in language. And now the last change, which is card. So generally, the RBI has noticed that card issuers do not follow a standard billing cycle for all credit cards issued. So in order to provide flexibility in this regard, the RBI has mandated that card holders shall provide a one-time option to card holders to modify their billing cycle as per their convenience. And with that, I will now pass over the mic to Aditya.
So we've received 2 more questions on the co-branding aspect in the box. Before we go there, a small advertisement by us, and this next 3 minutes, and I swear it's just going to be 3 minutes, is going to be a small product pitch from us. Everything else we've covered in the webinar before and what we'll cover after this segment was purely a legal analysis on the merits of the law, right? In these 3 minutes, please bear with me as I tell you a bit about the product. After these 3 minutes, I guarantee you, we will come back to the open Q&A, right? Because this, what we do can actually help you with 2 of the things that we talked about earlier, right? So legality, can you help you out with 2 of the new requirements, getting signed agreements done electronically and with direct digital consent flows, right? So with the new signed agreement, you might be worried about all the new paperwork logistics involved in making that happen in a compliant yet customer-friendly way that avoids drop-offs. With Legality's complete document infrastructure stack, we help businesses digitally transform their entire paperwork logistics in a fast, easy, and super compliant way. So using our infrastructure, you can build a smooth and simple flow for credit card onboarding, debit card onboarding as well, documents that is both compliant with the new regulations, but yet safeguards against customer drop-offs by offering a great UX. Right? We can also help you with direct digital consent as well, right? Because as we mentioned earlier, you may want to avoid the net banking flow for the customer and create a smooth experience outside the environment, right? With Legality Direct Digital Consent, we provide you a way to collect single-click virtual signatures backed by multi-factor authentication that also come with a verifiable, auditable, and trackable secure audit trails that have Evidence Act protection. So it make it very easy for you to show to the RBI, right? And here's how that flow would look. I'm not going to get into it. We covered the flow earlier, right? Our infrastructure is complete. And what we mean by that, it's not just about a basic e-sign utility. It's a very 2016 era thing. Even PDF readers have that these days. We provide you that, but also the other blocks you need to assemble a fully compliant flow in a digital way, and most importantly, at scale, right? And this includes super fast integration capacity and dedicated people services to actually help you go live and maintain the digital flow for years to come, right? We're already working with Bank of Baroda, Financial, SBI cards, and a few leading fintech companies in the space on some of their card flows. So we understand the nitty-gritties and pain points of card flows, right? If you want to get started on complying with at least 2 of the major changes in the new RBI rules for cards, with a free sandbox account, a detailed consultation, and a go live within 28 days, contact us now by emailing us at enquiry@legality.com. That's enquiry@legality.com. And with that, back to the open Q&A. So Shariar, since you last spoke, 3 more questions have come up on that issue, right? First question is, in short, a co-branding partner cannot be the service provider in terms of transaction processing. Is that statement correct? And if that is the case, would it not mean that the existing card-based fintech arrangements are not valid anymore? Shariar, you're on mute.
Sorry. Yeah, that's the question even you had asked, Ancha, in terms of what happens to existing arrangements. My sense is that they will be required to comply. And in terms of whether they're a service provider, so for the initial part, when they are actually required to do the marketing and co-branding and bring customers on board and do the initial port of grievance redressal, to that extent, they are a service provider. But once that takes off, they're not. They're out of the picture. And for existing arrangements that are not in compliance, my sense is that they are required to ensure compliance within the stipulated. But given that the time period is a little limited, maybe industry players may consider engaging with RBI to see how they can sort of, I don't know if the RBI will be open to an extension, but to say that they are in the process of ensuring compliance, and it'll take them some time to comply with that. Then I think there's another question
on PPI. So PPI backed credit line, like the buy now pay later cards, like Slice or Uni. How would that work?
So interestingly, if you look at the whole directions, while there is a definition of prepaid cards mentioned, but the use of that term is actually limited only in the co-branding part of it. So my sense is that it does apply to the PPI instruments as well.
Right. So this would be in addition to whatever is applicable under the PPI. Norms
of course, because when they define the prepaid cards, they do refer to the master directions on prepaid instruments.
And I think the thing about this is it's a PPI, but it's also backed by a credit line. So that nature of it being a credit card or a debit card or a debt instrument would also seem to indicate that the intention of the RBI regulations would be to apply to this as well.
Yeah, but again, I'd be a little more guarded than commenting on
cannot,
this.
Yeah.
We'll have to see. See, again, I'm just for the benefit of the audience, I mean, again, saying we're at a very nascent stage of these regulations. They've barely been few weeks before they've been issued. How they pan out, what they apply to, what happens to existing arrangements, how new arrangements will take place. I think the industry will sort of evolve in that space. So we will be watching it closely. And we do regular updates at CAM on the market developments that take place, and we do share those with clients on a regular basis. So as and when we have some clarity, we'll absolutely be happy to share that.
Yeah. In fact, we received a comment also that they are not applicable to prepaid cards. And I think that's a reasonable assumption to make. If it's a full-scale prepaid card, might not be applicable. Again, there are these ambiguities there, and we'll only know post July 1st.
Absolutely. Like even for example, on NBFCs, right? You spoke at some point in the presentation on the rules that are going to come forth. We don't know what those rules will entail, right? So similarly, I'm glad someone's clarified they don't apply. But again, there's no, at least within the text of the regulations, there's no clarity on that.
Right. So a slightly technical question on the co-branding aspect. Can the co-branding partner, i.e. the fintech or the NBFC, use a secured API to access the transaction details from the bank and show that in the partner app? Basically, it's like the banking interface opening up in the partner app, if I'm not wrong.
But would that mean, so my question to the audience who's asked that question is, would that in any manner give indirect access to transaction data? Because if it does, then you can't do it.
Right.
And even if it opens up because even if you're linking it through the banking partners app, so long as it shows up on the interface of the co-branded app, then that's not in compliance with the regulations, right?
Yeah, and I think on the second front, the responsibility has been vested with the bank for any
Absolutely.
transaction apart from the initial point or the initial point of grievance, right?
And
So
I think banks will be watching that very closely, Ancha, right? Because the moment responsibility, so earlier you could say that, you know, this part has been outsourced. In fact, there's a specific reference to what can and cannot be outsourced. So banks will be watching, in my opinion, this clearly, because this does in effect trigger the compliance requirement at the bank's end, because the onus has been so clearly shifted to the banks.
So on that secured API question, it's again slightly ambiguous, but on the face of it, on a safe reading of it, I don't think a bank may not be reluctant to, because it's responsible for that part, to part with any data to a co-branding partner's app.
I tend to.
Seems to be the tendency of the regulation. Again, the practical way this plays out, we'll only know after July 1st.
That's right.
It's definitely technically possible. That suggestion, it's definitely technically possible. But the practical implications, we will actually have to see after July 1st. The tendency of the rule seems to be to at least discourage, if not permit such a transaction to happen. So we have a question on NBFCs. For NBFCs seeking approval from RBI to engage in a credit card business, they've only specified criteria such as NOF and COR, right? Are we expecting any more information from the RBI on criteria?
I don't think
for the necessary go ahead.
Panel or in the audience can answer that question. I would never like to second guess the regulator, but given that it has opened up the space, we are definitely expecting some kind of rules and regulations to come around. What they will entail, we'll have to see, but broad criteria will be limited to NOF and COR.
Right. I think this question about sharing information on co-branded again, now we're back to co-branded, sharing information with explicit customer consent. I think unfortunately on that point, the directions don't provide such a card.
Aditya, no, actually, if you look at clause 27 of this, it says that card issuers shall not reveal any customer information obtained at the time of opening the account or issuing the card. You cannot reveal that information without obtaining customer's explicit consent. So my answer would be you can if you actually have explicit consent for that.
Yes, but not with a co-branded partner.
They're asking about.
I don't know if this question is in context with co-branding partner. I mean otherwise.
Okay, because the wording, my answer was going to be the same as Ancha, that if it is in the context of co-branding partner, the answer is no, because the 27A opens with card issuer and not co-branded partner. But if the question, that's fine.
I wasn't sure if the question necessarily meant in the co-branding context.
Right. So yeah, if it's for the issuer sharing that information with the customer, that requires explicit customer consent. If it's with the issuer sharing it with the co-branded partner, seems to not be permissible because of the explicit restriction in the co-branded provision.
That's correct. And again, this responsibility of data sharing also rests completely with the card issuer. So I don't think on a plain reading, we will ever extend this right to the co-branding partner as of date, at least not under section 27 of the directions.
Right.
Yeah.
I think
one question we had on
MITC.
I think someone had asked a question on this customer consent.
Yeah.
Whether
so the question was, can allowing the credit card holder to download the MITC agreement? So the RBI has a requirement that the signed MITC and signed agreement must be shared via email or registered post with the customer, right? Will it be sufficient? This question is asking, will it be sufficient for the bank to have the download option on the web page or on the net banking app where the customer can download? Would it fulfill that email requirement? Ancha, do you want to take this?
Yeah, it won't, because the language in the direction is pretty clear that a copy of the signed agreement must necessarily go to the email ID or to the postal address. There is no exception carved out for a download option. So to answer your question, Akansha, no. you can't have just a download option. It necessarily has to go to their email ID.
Great. Okay, so we got a clarification that information sharing was with co-branded partner. So
Okay.
That's not allowed. Yeah.
looking
Not allowed.
as Shahryar had earlier mentioned, we cannot with 100% certainty comment on anything because we'll only know after July 1st. Given the explicit restriction on data sharing with co-branded partner, it appears that you would have to read it to be that even with explicit customer consent, you can't share it with a co-branded partner. Again, the caveat, maybe an annoying caveat at this point in time, ultimately the practical way this plays out, we'll know after July 1st.
That's right.
I also would like to give an opportunity for people to, like, if you want to talk, you can raise your hand and we'll also give you mic access. I think we have about 2-3 minutes. But otherwise, this was a great set of questions we received and good inputs as well that actually have shaped our understanding as well on what it is, like the input on prepaid cards or prepaid instruments. So, I mean, I think this is the discussion around this is going to continue to be lively for the next few months. So for keen watchers of the space, this is probably the hot button issue that we'll see a lot of activity on.
Yeah, for sure.
I think, but the overall theme of the RBI here has been prioritizing customer consent and data privacy.
Yes,
right?
Yes,
above anything else. Yes.
Above anything else. Great.
And also opening a window of opportunity for NBFCs.
Opening a window of opportunity for NBFCs.
Yes.
I'm sticking my neck out and saying that. So, but yeah, hopefully.
Great. Shahryar, thanks so much for making time for this. This was a great.
Absolutely. It was great speaking with you guys. And I think we had a fantastic audience, some really thought-provoking questions and leaves us also with some food for thought. So it's been great.
Yeah.
Thank you so much.
Again, hope you guys had a good session. If anyone missed it, do share the recording with them. Shahryar, once again, thank you so much. And hopefully we'll be able to collaborate on something similar in the future.
Definitely look forward to. Thank you. Bye-bye.